In a few years, or let's say in 2023, the US economy is reportedly in jeopardy, and market expert already predicted this forthcoming analysis being the graveyard of the US economy. If caution is not exercised, companies will crumble and fall. So, what are the market analysts' warnings regarding the US economy? We'll highlight them in this video. But before we start, please like and subscribe to the channel and then sit back and relax. The US bond sends a recession warning to the US. There has been an inversion in the Treasury yield curve spread. The US bond market was the latest to issue the warning that the US economy may be suffering contractions or has even entered a recession. Experts have pointed out that there has been an inversion in the Treasury yield curve spread, that is between longer and shorter durations Treasury yields. Typically, longer duration yields such as the 10-year bond are higher than shorter duration yields such as the 2-year bond. But right now, the 2-year yield is higher than the 10-year yield. This reversal is the warning sign that has led economists to believe that the economy may be weakening and that a recession is possible. The yield curve measures the difference between a bank's cost of money and what the bank will earn by lending or investing it over a longer period. If banks can't make money, lending slows, and as a consequence, so does the economic activity. After rising sharply to nearly 3.5% in mid-June, the 10-year yield has plunged to 2.78% below the 2-year yield, which has been in the 2.79%. The 10-year note had risen on inflation but reversed course as investors have become more concerned about the economy. In recent weeks, the market has been fearful of the possibility of a recession. Economic data has weakened, and Federal Reserve Chairman Jerome Powell has indicated that the central bank will remain steadfast in its fight against inflation and in bringing it down to its 2% target. Investors, for their part, are more concerned that the Federal Reserve's monetary tightening will raise interest rates so much that it will slow the economy to the point of recession. Gregory Farinello, head of U.S. rates at Emory Fed Securities, has noted that Powell was recently asked about the potentials for a yield curve inversion. And his response was, "We are not worried about that right now. We are concerned about reducing inflation to 2%. It's inflation over growth, and the Fed isn't worried about an inverted yield curve." Investors have also turned their attentions to the Atlanta Fed's GDP. Now, economic indications, which has forecast that gross domestic product growth will contract by 2.1% in the second quarter of 2022. This, coupled with a 1.6% drop in the first quarter, would meet the technical definitions of a recession. With 2 consecutive quarters of GDP contraction, the Federal Reserve has repeatedly reiterated the strength of the U.S. labor market and has stated that the economy can withstand the movements of monetary policy. Despite contracting economic growth in the first 3 months of the year, Fed Chairman Jerome Powell has been optimistic about the current health of the economy, saying that he is in good shape. What were market experts warning on U.S. economy in 2023? One study highlights the need to apply policies to curb inflation without exacerbating the risk of recession. As central banks around the world simultaneously raise interest rates to respond to inflation, the world could be inching toward a global recession in 2023 and a series of financial crises in emerging markets and developing economies that could cause them lasting harm. According to a new comprehensive study from the World Bank, central banks around the world have been raising interest rates this year with a degree of synchronization not seen in the last 5 decades, a trend that is likely to continue well into the next year, according to the report. However, the currently anticipated trajectory of interest rate increases and other policy measures may not be sufficient to bring global inflation back to pre-pandemic levels. Investors expect central banks to raise global policy rates to almost 4% by 2023. A figure that represents an increase of more than 2% points above the 2021 average. The study posits that unless supply disruptions and labor market pressure abate, such interest rate increases could leave the global core inflation rate, excluding energy, at around 5% in 2023, almost double the 5-year average before the pandemic. To bring global inflation down to a rate consistent with their targets, central banks will likely need to raise interest rates by an additional 2 percentage points, according to the report's model. If this were accompanied by financial market stress, global GDP growth would slow down to 0.5% in 2023, a 0.4% contraction in per capita terms that would meet the technical definitions of a global recession. According to David Malpass, president of the World Bank Group, global growth is slowing sharply and a further slowdown is likely as more countries enter a recession. I am deeply concerned that these trends will persist, with lasting consequences that are devastating for people in emerging markets and developing economies. Policymakers might switch their attentions from lowering consumptions to raising productions to achieve low inflation rates, monetary stability, and quicker development. To increase investment and reduce poverty, policies should also work to increase capital allocation efficiency and productivity. The analysis emphasizes the extremely challenging conditions that central banks are now fighting inflation under. Many past global recessions indicators are already sounding the alarm. The current post-recession rebound for the world economy is the steepest since 1970. More dramatically than in the lead-up to previous worldwide recessions, consumer confidence has declined globally. The three largest economies in the world, the US, China, and the Euro area, have all seen a significant slowdown. In these conditions, the world economy may experience a recession even if a mild shock occurs throughout the course of the ensuing year. The report examines current economic activity, evaluates recent changes, and proposes possibilities for 2022-2024 based on lessons learned from previous global recessions. To stimulate economic activity during a slowdown like the one currently occurring, counter-cyclical policies must often be implemented. However, even as the global economy slows dramatically, officials in many countries are removing regulatory assistance due to the prospect of inflation and limited fiscal flexibility. The experience of the 1970s, the policy responses to the global recessions of 1975, the subsequent period of stagflations, and the global recessions of 1982 illustrate the risk of allowing inflation to remain high for a long time while growth is weak. The global recessions of 1982 coincided with the second lowest growth rate in developing economies in the last 5 decades, second only to 2020. It triggered more than 40 debt crises, followed by a decade of lost growth in many developing countries. According to Ihan Kosei, acting vice president of Equitable Growth, Finance and Institutions at the World Bank, the recent tightening of monetary and fiscal policies is likely to help reduce inflation. However, since the policies are highly synchronized across countries, they could aggravate both the tightening of financial conditions and the sharpening of the slowdown in global growth. Policymakers in emerging markets and developing economies must be prepared to manage the potential spillover effects of the simultaneous global tightening of policies. The study argues that central banks should continue their effort to control inflation and that it can be done without causing a global recession. However, it will require concerted action by various policymakers. First, central banks must communicate policy decisions while safeguarding their independence. This could help anchor inflationary expectations and reduce the degree of restrictions needed. In advanced economies, central banks should keep in mind the cross-border spillover effects of monetary policy tightening. In emerging markets and developing economies, they should strengthen macroprudential regulations and build foreign reserves. Secondly, fiscal authorities will need to carefully calibrate the withdrawal of financial support measures while ensuring consistency with monetary policy objectives. The share of countries that will tighten fiscal policies next year is expected to reach the highest level since the early 1990s. This could increase the effects of monetary policy on growth. Policymakers should also establish credible medium-term fiscal plans and provide targeted relief for vulnerable households. Another fact is that other economic policymakers will need to join the fight against inflation, taking strong steps to boost global supply. Among these measures are easing labor market restrictions, which should be accomplished by encouraging higher labor force participation and lower price pressures through policy measures. Labor market regulations may help reallocate displaced workers. The expansions of the global supply of essential goods is a further action. Increasing the supply of food and energy can be significantly helped by global coordination. Policymakers would need to speed up the switch to low-carbon energy sources and implement steps to cut back on energy usage in the case of energy commodities. Lastly, to improve global trade networks in this regard, policymakers ought to work together to ease supply constraints around the world. Supply a global economic system based on norms that protects against the fragmentations and threats of protectionism that could further harm trade networks. If you enjoy this video, don't forget to hit like, the subscription button, and the notification bell. To get notified when new videos are uploaded from this channel, please share your thoughts about several warnings that have been issued on the US economy by market experts in the comment section below. Thank you.